I'm Justin Hayek, investment advisor with PI Financial. Join me on a ride with today's top CEOs. Hear the stories of their greatest achievements and failures. Get the inside on their secrets to investing and the latest on their next big deal. This is Car Ride Confessions of a CEO. Joining me on today's ride is David Cates, President and CEO of Denison Mines and Uranium Participation Corp. David is highly regarded as a uranium industry expert and is often called upon to speak at conferences around the world. Tell me a little bit about Denison Mines, essentially the elevator pitch, and why you think investors should own it.
I think what we're really trying to do with our company and why people should look at it is because we have visibility to becoming that mid-tier producer in this cycle, right? We have an asset in Wheeler River that's in and amongst all the infrastructure in the eastern Athabasca Basin, right amongst all of Cameco's flagship assets. And so the idea is really position our company to be the next producer, be part of this next bull cycle, not the next bull cycle down the road, but this one that's upon us. I think we're coming out of the bear into the bull market. And there really isn't much else that you can get into where you want like large scale exposure. We'll be producing at Wheeler maybe 6-7 million pounds a year. That's 2 to 3 times the whole US market for uranium production. So I think at the highest level, that's really it, is saying like which of these companies that are out there can be a producer in the next cycle, give you that super torque to a rising price.
Now, tell me a little bit about Uranium Participation Corp and why you think, again, investors should own it in their portfolios.
All right, so like UPC is a different proposition, right? It's physical uranium. It's like a ETF, but it's not an ETF. For physical, you buy UPC, you own your notional cut of our holdings, and all we've got's uranium. I equate UPC. It's like a gateway drug. It's a gateway stock. It's easy to get into UPC first because of lower risk. You get into UPC because you've got physical asset behind you. You're going to be linked to that commodity, but you don't have to worry so much about like the business specific risk of a mining company.
Right.
So I think it's an easy place for people to get their feet wet. Like I said, gateway, get comfortable with the commodity. And then as they get more and more comfortable about where it's going, you're probably going to want to get into something with a bit more torque, like a developer. But that's how I see people looking at UPC. Like it's marginable, it's good value stock backed up by the physical, really much less risk, but still you won't miss out on the first run as this market turns around. So
talking a little bit about maybe pricing action on uranium, what's your outlook on the uranium market itself?
Well, it's been a pretty tough market.
Yeah.
I think you have to have a positive outlook from where we're at now. 12-year low prices we touched late November 2016. We've rallied off of that. I'm really optimistic about where it goes. And, the reality is I gave a presentation last week in Toronto, and I tried out a new sort of slide deck. And so there's 5 themes right now in the space. And this is kind of the reason why I still have resolve about where it goes. Number 1, demand. It's been slashed by almost all measures because of various things that are happening politically. And yet, we're still projecting between 1 and 4% annual growth in nuclear reactor capacities, right? So despite all these cuts, we still have a good growth story. The supply side, we've got the world's largest and highest grade uranium mine coming off right now because Cameco is saying, look, this doesn't make sense for us. Number 3, our contracts are coming off. So all this protection, our third theme here, all this protection that the utilities or that the producers have had from long-term contracts with the utilities, well, they're expiring. So now you've got still demand. Demand scenario still makes sense. You've got supply curtailments coming off. Like MacArthur is a world-class tier 1, all those kind of thing mines. Should really never shut, but it's shutting because contract protection is coming off.
Right. And
the commodity price doesn't make sense. Fourth part of this thing, and the fourth theme, is that new mines, like they're not being advanced. Very rare. Denison's like the outlier in this. And the mines that can be built at lower prices, like maybe in the Athabasca, takes us time. Permitting we have to go through, you're talking maybe 7 to 10 years. So who's going to fill the void if this demand materializes sooner? It's going to be what, Africa? Well, African assets need $75 uranium. So I call it a dysfunctional project pipeline. There's nothing that fits into like the quadrant of low cost, quick to market. Mm-hmm. And then the last part of it is you have all of that on the table, and somehow the utilities are complacent about it. And they don't go and they buy. And, you know, the price runs up on an event like a MacArthur's curtailment, and the utilities say, oh, well, I'm gonna stay back and see what's going on here before I jump in. It's too frothy for me. So you know what they do? They don't buy. Well, if they don't buy, then the price goes back down.
Right.
Because at the end of the day, they're the only real buyer. And then they look at that and say, oh, see? Well, guess what? The price didn't go up.
Right.
Came back down. I was right. But if they keep doing that, we get to a point where when they want to buy, they don't have anything to buy.
You touched on the Lundin name. For those who don't know, Lukas Lundin is the executive chairman of Dennison.
Yeah.
Now tell me, how beneficial is that to have someone like Lukas basically at your fingertips?
Well, it's good and it's bad, right? You know, Lukas is my boss, so we get some unpredictable calls from Lukas at various times, and just wanting to know what's going on, and sure. That's all good. I love it when he does that. But on balance, no doubt, it's amazing. How many people can you tap into that have like the resource acumen that Lukas and the Lundin family have, and the access to capital that they have? But what I love about Lukas is, you know, the thing he gets most upset about is if you don't ask him something, right? He wants you to know that he's there. That's why he's our executive chairman. If we need him for something, we need direction, we want to bounce an idea off of him, he'll only be upset if we don't ask him.
Now I've got a list of questions which I'm looking for just one-word answers.
All right, I'll try my best.
So would you say the bottom is in for uranium prices? Say specifically the spot price of uranium.
I'd say yes.
Okay. And now put you on the spot. What will the spot price of uranium be 1 year from now? We'll call it January of 2019.
Well, that's not a one-word answer. If things go let me give you two parts, okay? Sorry, I'm gonna break the rules. If things go our way, we have every reason to believe that we could be approaching $30. If things don't go our way, we definitely could test the low 20s like we are right now.
How would you describe your job as a CEO?
Yeah, it's engaging.
What kind of music do you listen to while you're driving?
I use a lot of new rock inspired by old rock.
What is the best investment you've ever made? Whether, you know, for your PA personal account or through the company, whether for Dennison or Uranium participation? And what is the worst investment you've ever made?
All right. Well, best investment's probably a recent one. And it's not a glamorous, you know, like 100 times return. But when Amazon came out and had that deal with Whole Foods, all the U.S. retailers got whacked. And I was already into Target a little bit, mostly for like, you know, modest sort of dividend yield. But I doubled down totally on that. I thought, you know, this seems irrational that the market would whack these retailers this bad. And Target got really whacked. So I took pretty much everything I had out of any other U.S. retailer that hadn't been whacked as hard, rolled it into Target, and Target has rocked it since then. So that has been probably the best play I've made in the last little bit. Really happy with how that's gone. Worst one is more of a basket of terrible investments. A bit of a personal story, but basically, you know, coming out of, you know, I used to work at an accounting firm, and my background is in finance. I'm a CPA, and I was looking basically to make a few bucks, and coming into the market at the very beginning. So it was probably my first foray into the market was my worst. And I actually borrowed like 10 grand, a line of credit, put it into a margin account, margined it up, and I bought all resource stocks. Thinking, you know, I know all these resource companies. Sure, I know what's going on. Well, you know when this was? This was 2008.
Oh, no.
Right. So the funny part of this story is that the only stock that I actually ended up keeping, so I lost it, like literally everything. I lost 95% of the 10 grand that I borrowed after I cleared out my margin account. I held one stock. It was Denison Mines.
Really?
I wasn't even working at Dennison at the time. I think I just left PwC. I was working at Kinross Gold. and I still have the position in Dennison, but literally that was the worst call, was to believe that I had it all figured out. In 2008 was the time to borrow and margin into the resource market.
Yeah. David, thank you very much for your time. Appreciate it. Hope you enjoyed it.
We'll do it anytime.
Excellent.
All
Thank you very much.
Thanks so much.